Tariffs and uncertainty have caused the market to drop, but not everything. Over the past month, the S&P 500 fell almost 7.5%. My portfolio dropped by just under 4.5%. Today, we're going to look at the stocks and funds from the portfolio that didn't get sucked down by the market. They have an average yield of 11.1%, and some of them actually went up. August 5th was the worst day for the market of 2024. So at the end of 2024, I made this video about 4 investments that held up pretty well. Today, we'll expand that to 11 stocks and funds. And instead of focusing on one day, we'll look at the past month. While the S&P 500 fell almost 7.5% over the past month, these 11 either went up in value or fell by less than 1%. I've organized them into 5 categories: healthcare, credit, preferred stocks, infrastructure, and real estate. Healthcare is a logical one. This sector often holds up during economic turmoil. THQ yields just over 10%, holds over 100 healthcare stocks, and is heavily weighted to many of the big names you're probably familiar with, like Eli Lilly and United Health. The fund generates income by selling covered calls on some of the portfolio and capital gains when it sells individual stocks at a profit. There's also 20% leverage to boost the income. I think they overdid it with the huge distribution increase in 2024, but even if they cut that by 20%, it's still a decent yield. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's available via Armchair Insider, link in the description, it's free. Next up is the largest category for today, credit. I have 5 tickers in this category that held up quite well. Credit is not represented on this sector chart. The closest thing would be financials, but that's far too broad. Financials includes things like publicly traded banks and stockbrokers. Credit in today's example is private lending to businesses or by businesses. For example, corporate bonds, business loans, and collateralized loan obligations or CLOs. We don't have time today to study each of the 5 tickers in this category, but I've made detailed videos on 3 of them. I'll link them in the description. These are all a form of lending, so they're affected by interest rates. For the first time in what seems like forever, the market is not actually focused on interest rates at the moment. It's focused on tariffs and trade wars. Meanwhile, these credit funds are enjoying being out of the spotlight. Credit funds face their own risks, though. For example, if the economy fell into a prolonged recession, then defaults would increase and that would reduce their earnings. But for now, the current turmoil that's crushing tech stocks hasn't affected them. For example, FSCO has been a superstar. Look at this 1-year return chart. It tripled the S&P 500. Very happy with this 11% yielder. John Bowman released this updated analysis of FSCO on March 6th of this year on Seeking Alpha, which I found quite helpful. If you'd like to get the latest on this fund, FSCO, he breaks down the loan portfolio, the valuation, and why the fees aren't as high as they look. Articles like these are the foundation of my research. I'm on the Seeking Alpha app or the website pretty much every day, mostly on the app though. I'll link to John's analysis, and I'll include a separate link for a discount on Seeking Alpha membership and a free trial. I use the premium level. The next category is a specific asset type within the financial sector, preferred shares. Regular stocks, also known as common stock, pay distributions based on the current financial health of the business. If earnings are down, the board is likely to trim the next dividend or even cut it. Preferred stocks are more like a loan that must be repaid first. In other words, before the common stock dividend. The amount to be paid isn't based on the quarterly financial position of the business. It's based on the terms defined when the preferred stock was issued. For example, AGNCN preferred stock was issued with a fixed yield of 7%, which means 7% of its face value of $25. We can see the consistent 7% yield was paid here. Some preferred stocks switch from fixed to floating, and that's why the dividend started increasing here. AGNCN is currently floating at the secured overnight financing rate plus 5.37%. So that means as interest rates decline, if they decline, so will AGNCN's distributions. We can see where that started to take effect here. Important to note that this preferred stock is now callable, which means the company could force preferred stockholders to sell the shares back to the company at $25. So obviously you don't want to pay much more than $25 for this one. At roughly $26 as I record this, AGNCN is currently a little bit expensive. That video I referenced earlier covered AGNCN, EICC, and NLYPF in more detail because they all held up well during the August 5th dip in 2024. I'll link it in the description. I recently purchased some more EICC and NLY Series F, and it was covered in the February 28th edition of Armchair Insider. Infrastructure is another one that usually holds up during panic periods. It's not called out in this sector chart, but its close cousin, utilities, has held up reasonably well. It fell less than most sectors. ASGI is yielding almost 13%, which does imply above average risk. Ironically, its price has been quite volatile until recently. Infrastructure and utilities are very capital intensive. For example, it costs a lot of money if you want to build a power plant, so usually it involves some sort of borrowing. For this reason, they're sensitive to interest rates. When interest rates were climbing, this fund took a beating. The distributions have been consistent and have grown, but this jump that began in May 2024, not as exciting as it looks. It wasn't the result of an increase in net investment income, which would have been great. It was just a change in distribution policy. The fund went from distributing 9% of net asset value to 12% of net asset value. That's a lot to distribute. Initially, the market liked it and the price increased, but it's difficult to sustain 12% over the long term. I wouldn't mind if they dialed it back to 9% of net asset value. Our last category today is real estate. This is another sector that has held up well recently. RLTY is yielding 8.5% and has paid consistent distributions over its relatively short 3-year lifetime. Snowball is handy for distribution charts like this, but I mostly use it to combine my stocks from 3 brokerages into one simple dashboard. I can rank by yield to see how I want to rebalance my portfolio, and the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for the Armchair income discount and a free trial. RLTY holds a basket of REITs. Some of the larger holdings include Welltower, which has nothing to do with wells or towers. They hold medical office buildings and senior housing developments. Not to be confused with the second largest holding, American Tower, which does own towers, more than 40,000 cell phone towers in the US, and more than double that outside the US. REITs don't generally pay yields as high as 8%, so they use more than 30% leverage to boost the income, which is a lot. Each of these categories comes with its own risks. Apart from the risk added by the leverage that I just mentioned, if interest rates were to climb again, it would be a bad thing for REITs. The 11 tickers I've mentioned in this video have been in my portfolio for a while. I just added a new fund that's also in the real estate sector, and this one doesn't use leverage. IYRI from NEOS is a covered call index fund, and it recently launched an ETF based on the Dow Jones US Real Estate Capped Index. It's a mouthful. It uses a covered call option strategy to boost the income from that index from about 2.5% to just over 10%. That higher yield doesn't come for free. The NEOS fund won't appreciate in price as much as the IYR index fund. We can see that on this 1-month price chart. But when you switch to the total return chart that includes distributions, well, then there's not much of a gap between them. I referenced IYRI in the recent edition of Armchair Insider. I hope to get Garrett from NEOS back on the channel to explain the inner workings of that ETF. Before we wrap up, a few quick observations about the rest of the portfolio. BDCs weren't immune to bad news, but they fell less than the S&P 500. The exception was HTGC because it was so highly valued at 1.86 times book. That's a lot. Now it's down to 1.53. Still a lot, but better. This price-to-book chart from the comparisons tool on Seeking Alpha shows how the more conservative ARCC fell less. Both are excellent BDCs, but HTGC is known for having an extremely volatile price. I watched Dividend Bull's recent video and noticed he is currently buying the dip for HTGC. I'm keeping an eye on it. JEPI moved the least of the covered call index funds. This was to be expected. It's built for reduced volatility. SBYI is based on the S&P 500, but fell less than the S&P 500, 5.2% versus 7.4%, which is good. Then below the S&P 500 line were funds based on tech growth like BST and FEPI, no surprises there. And of course, Bitcoin income funds were pounded. They pay massive distributions, and sometimes, well, there's a price to pay for that. When Bitcoin does well, they print lots of cash, and when the Bitcoin price drops, it can be dramatic. For this reason, my allocation to Bitcoin funds is fairly small, currently a little bit under 2%. However, let's get some perspective, because BTCI was launched on October 17th, 2024, and if we measure total return, that's price and distributions reinvested, since that date, the S&P 500 is down 3%, and BTCI and BITO are up 16 and 20%, which is actually better than I expected. I'm not suggesting that everyone should just rotate into the 11 stocks and funds that fell less than 1% in the portfolio. Every investment comes with its own set of risks. Even though these stocks and funds weren't dragged down by the market recently, they could be affected in the future by changes in interest rates, a recession, or a government policy change that we don't yet know about. My point is that diversification beyond regular stocks and regular stock funds can provide a buffer from some of the market's volatility. If you want to learn more about the stocks and funds I mentioned today, I've made videos about most of them. This channel has over 100 episodes now, so to save your time, Armchair Insider includes a link to the most recent video next to each stock or fund in the portfolio. That wraps it up for this look at 11 stocks and funds that didn't get pulled down with the recent market downturn. More Armchair Income coming soon.